overview of what you've seen, what you've heard since you've been there. Would you be happy with that?
So from what we have seen, there really isn't anything concrete coming out. Until yesterday, they had really not managed to agree or even come to a consensus on any of the important topics. And so in that sense, it's really not going anywhere. The presidentials are on right now. They have the ministers and presidentials, I think, yesterday and today. And the UN chief had to step in yesterday because it really was going nowhere to kind of see if we can have something to put on paper.
Yes.
But no. The sessions, etc., that we did, fair amount of crowd. It's a very small place. It's smaller than the earlier COPs. So it was packed. We had good speakers across sessions. So everybody who's in this space is here. But the negotiations are just dragging as of now, unless they come up with something in the last 2 days.
Yeah. It's a difficult agenda this year with the, particularly around the financing commitments, the 100 billion, the famous 100 billion financing commitments. That's a very...
and they're worried that the Kyoto Protocol is running out, so they're out of time on that.
Yes.
So, yeah.
I've been, there's a whole sort of group of people writing now that are talking, about how this has become sort of the sideshow. And of course, there's such momentum around a number of things, but solar in particular, that, it starts to become, the process has become inverted, where this is really the COPs and the whole UNFCCC process are really reflecting what's happening rather than driving what's happening.
Yeah, that's true, because it's actually more like an expo. It's very much like the WFES or that sort of forum where people come in for the conference and the expo and the discussions rather than the actual. You don't really realize that there's some negotiations going on unless you are directly in touch with the governments. And so some of it we know because we are here with the MNRE. And Dr. Methani, who's our core negotiator, has been working with us on, because he belongs to the MNRE. So through him, we have sort of a direct input into this, but otherwise, one, it's really secretive and there are no daily updates, so we don't really know what's happening. And everyone's on the periphery of the conversation. So in that sense, it's no different from, let's say, Abu Dhabi's WFPS or any of these conferences that we go to.
Right. Yeah, and there's very much, for those that haven't been to a COP, there's very much two things happening at simultaneously. One is the sort of the circus that's going on outside the negotiations, which is, about all of the side events, about all of the industry. Now, increasingly, it very much, as you said, Shiva, starts to look like a trade fair where a number of, companies have set up and making booths, all these kinds of things. And then there's the circus inside the negotiation, which is, a process that it's very hard to keep track of what's actually going on. It's a very fluid, fast-moving thing, and usually it collapses where all of the progress is made in the last 24 hours, or if there's any progress, it happens all within, the negotiators stay up 48 hours straight and they try to get things, the ministers come, and it's all of this, the 2 weeks is kind of wasted, and suddenly in 24 or 48 hours, they try to salvage something out of it. So it's a very bizarre process, actually.
Yeah, but this year they were expecting, I think, around 50 heads of states, and they've got only, I think, about 20 come in, 20, 25. So even the representation at that level has been, very weak.
Right. Yeah. Good. Thank you for that. So then so from there, let me just say welcome to everyone. We are here in London, Bruno and myself. Hi, everyone. And a little bit of an early start because we have a guest, Girish, with us who's in California today. So late at night his time. So Girish, thanks for staying up late to make this happen. So let me just sketch out a rough agenda for today, and then I'll introduce Girish and we'll get started with the presentation. So the basic format will be similar to last week. So what we'll try to do is we have a presentation, but I've asked Girish to try to break that up into three distinct pieces so that Shubha and myself can try to get you all involved right off the bat, and we don't wait too long to try to make that interaction happen. As we know, these sessions are really one of the few instances that we have to interact as a group. So obviously the prime concern is getting you engaged in that conversation. This week in the course, what we've really been doing is now shifting gears from what would be, let's say, the economics of corporate renewables into the financing. And the reason that the financing really dominates is because when you have a very high capital cost technology with very low operating cost, as solar is, then really a huge consideration about whether it works or not is the ability to get the cost of capital or the weighted average cost of capital for the project to its lowest possible level. And so, time and time again, when, not in just this course, but the courses that I teach at Imperial with the executive MBA or with the other MSc programs, it's really comes as some surprise, I think, to some of the participants in those seminars, that how much time we spend on finance, and they sort of wonder why, I didn't think this was going to be a finance course. And so I'll just say as a background, the reason this course as well starts to shift in both to our, and this week you'll notice on the platform we've done a lot of review, what might be review for some people about some of the basic concepts of financing. For some people who have maybe more of a public policy background, hopefully that will be new and interesting. But the intention there is to get us into a common language. And that language is really necessary because at the end of the day, financial structuring is not just something esoteric that's done by the banks, but something that everyone needs to have a minimum level of competency at in order to understand what are the real drivers about whether projects are going to work or not. So our emphasis now as we go forward in the course is really because, not finance for the sake of it, but because we believe it's a really important driver, just like policy, is in order to determine what kind of growth we can achieve in this sector. And so in that respect, really happy to have a colleague and longtime friend, Girish Ramali, with us today. Girish is a research fellow here at Imperial College. He's also a fellow at Stanford University. Many of you may know him because he was the country director for the Climate Policy Initiative for many years. He's also been an assistant professor at ISB in Hyderabad. So he's had a fascinating career working both within India and in the US and really globally, looking at these issues, and has had an enormous, I would say, depth of knowledge. And we're really pleased for him to come and share what he's been looking at in this area, and share some thoughts about how financing of distributed solar needs to work, how it can work, and what are the primary barriers on the financing side that are that they're trying to overcome through a number of both national and multilateral initiatives. So with that, Girish, thanks again for being with us, and I'll hand it over to you to walk through the first section of your presentation.
Thanks, Charlie. I hope you can hear me okay. So Charlie has given a pretty nice background. Thanks a lot for that. Thanks for inviting me for the class. And as Charlie mentioned, I'm going to focus on what we call catalyzing distributed solar financing in India. And I'm going to focus on the broader distributed solar financing, not just corporate. That includes perhaps what we call commercial and industrial, perhaps also residential. And the idea is that we need to bring in finance from the private sector using public money, and how can we do that? As Charlie mentioned, I was at Climate Policy Initiative. I was the India director until recently. I still work with Climate Policy Initiative, and a lot of this work was done, and it's been going on at Climate Policy Initiative India office. So let's go to the first slide. This is the agenda that I have for today's talk. It's essentially in basically 4 sections. I will start by talking about the context, the opportunity for distributed renewables, especially distributed solar, and talk about some of the challenges. And that's the first bullet. I will also start talking about some of the barriers to financing distributed solar, and start to connect that to a couple of catalytic finance interventions that we've been working on. And then from bullet 2, I'll directly jump to bullet 4 and give you a sense of what one of those interventions is going to look like. So I'm going to skip over into the bullet point 3. With that, let's move on to the next slide. So this is basically a very high-level overview of where the power sector in India is today, and as you can see, there is a huge transition going on in the power sector in India, as anywhere else in the world. And what we are seeing is that from a centralized fossil fuel-based architecture, now we are starting to move towards a decentralized renewables, electric vehicles-based infrastructure. And some of the kind of the drivers that we start to see initially, as you all know, that policy and subsidies drove a lot of penetration of renewables. But what we are starting to see now is the economics and the cost of renewables is becoming very, very attractive. What we see is that, for example, in large-scale solar, the tariffs that we are starting to see are below the price of new coal in many places. It's definitely below the price of imported coal. And another interesting thing that's starting to happen that I would like to mention, and there's a lot of work going on, is that at this point, if you look at the new solar or utility scale or large scale solar, we are starting to see tariffs, or what you call levelized cost, or the average cost of power projects being less than variable cost of coal plants. And you know, there are different analyses on that, but you know, a ballpark number is that approximately 100 gigawatt of coal capacity is no longer economic compared to you know, new solar, and not economic from the perspective of even the variable cost of coal is higher than the levelized cost of solar. And you see similar trends happening not only in large-scale solar, but distributed solar, as you can see on the chart on the right-hand side, which is comparing the cost of rooftop solar and the tariffs for industrial sector. And you can see that rooftop solar is competitive. There's a business case. So that's starting to drive a lot of penetration. We are also seeing that mini grids are becoming an integral part of providing energy access. We are starting to see that mini grids are an integral part of providing extension to the grid in Bihar and UP. And you know, in many ways, distributed renewables are attractive compared to diesel generation, where distributed renewables are coming at less than 10 rupees, where diesel is more than 15. So just the economics is starting to change the power sector in many different ways. Moving to the next slide, and here is where we start shifting towards distributed renewables. Distributed renewables means rooftop solar. Distributed renewable means mini grids, off-grid solar, and the key is to realize that while India is doing very well on meeting the large-scale renewables targets of large-scale solar or large-scale wind, there's still a long ways to go on distributed solar. And as you know, and just to remind you that the distributed solar target for 2022, which is part of India's NDC, is about 43 gigawatts of distributed solar, of about 40 gigawatts of rooftop, and 3 gigawatts of off-grid. And we need approximately $40 billion of capital coming into the sector to fund or finance this target. And if you look at where we are today, despite incredible growth in the sector, we see that we are about 2 to 3 gigawatts of capacity, and we are like three years away from 2022, where we are supposed to be at 40. So it's still a lot more work needs to be done. Still, there are a lot of work that needs to be done on policies, but there is still a need to move more financing for sure. What we are seeing right now is that most of the rooftop solar installations, and this is where I'll end up focusing most of my talk, while kind of mentioning off-grid solar at places where it's necessary, that most of the installations in the distributed renewable space is happening with either first-tier developers or first-tier off-takers. And when I say first-tier, which means just think of credit rating, think of rating by the banks, and these are basically the cream. And if we just keep on doing this, we are unlikely to get to even 10 gigawatts by 2022. And that's been pointed out in many reports. So there is a lot more work needs to be done. And this is despite there is a lot of credit and a lot of financing available through a lot of these credit lines, or the cheap credit that has come through the World Bank, that has come through the ADB, as well as KfW through government institutions like SBI, PNB, Punjab National Bank, and IREDA. So moving forward, where do we need to go? And that's where we're heading towards. Where do we need to go on the distributed renewable side? And as you know, that a lot of distributed renewables so far has been driven by government procurement and subsidy schemes. And now, as I mentioned, that economics is starting to drive a lot of that. But despite the fact that economics is starting to drive penetration of distributed renewables, the market is heading towards a plateau. And what I'm going to talk about now is we are going to end up focusing quite a lot on that. And here, what I'm talking about is that, as Charlie was mentioning, there are two types of models or business models that have come up. One is called the CapEx model, or the capital expenditure model. And in this model, a consumer basically pays for solar upfront and gets solar installed. This model, even though it was attractive and it has been attractive so far, as I mentioned earlier, it has worked only with basically rich companies or tier 1 companies. As we go deeper into the segment, we need to get rooftop solar installed at what we call small and medium enterprises, which comprise of a large sector of the Indian economy. And the issues that starts happening there is that these small and medium enterprises do not have enough capital to invest in capital expenditure. And B, if they want to go through another model, their credit is either not available or is not high enough. And what I'm starting to mention is the second model, which is called the third-party financing model, which has a lot of potential, where a third party comes in, installs and finances the project, and signs a PPA, or power purchase agreement, or lease with the SME or the customer. And this is where we start to see that finance is not moving because there's an issue around the credit of the off-taker. So this is an example, and this is where we start seeing that there is a need for catalytic financing interventions, where the public money or the public sector could come in and provide comfort to the private sector to move the capital. And that's what we're going to start focusing on. And I'm going to just talk about this one more slide, and then I'll take questions just for this section. And what I wanted to talk about is we're starting to move into what we call barriers to investment or barriers to moving money for financing of this particular model, which we call the third-party financing model, or the RESCO model, Renewable Energy Service Company model, which is starting to become more popular, especially with customers who do not have upfront capital to spend on solar. And what we see is that there are many barriers, and we'll come to barriers on many slides, but this is kind of a start, kind of a glimpse into that. I'll focus on the first three as a group. As we look for financing for projects for small and medium enterprises, whether these small and medium enterprises are developers or whether they are off-takers, we see that it's hard to get these project finance for various reasons. And the first three combined, which is essentially indicating the issue of bankability of projects. It's very hard to get information on projects. The ticket sizes are small, and the transactions or the loans or the applications for loans are not well structured. And all these point towards a need for what we call a project preparation facility that I'm going to talk about in a little bit. The next two are issues that I've already talked about, and that has to do with risk. I'll get into that a lot more later on, so I'm going to skip that for now. But this kind of gives you a sense of what kind of financing issues that we are seeing in the sector. And I do want to kind of point out here that here I'm focusing only on financing issues and not on policy issues. So, and that could be handled separately. So with that, I will stop for a few minutes, take questions, because now I'm going to start moving into describing a couple of these facilities that we've been working on. So happy to take questions.
Thanks, Girish. There's a question here. It says this, which says about involving. Maybe last week we talked a lot about discoms and how they can get involved. And the question here is about does involving the discom help improve? How does that change the picture around credit risk, and is having the discom involved a good thing or present even more challenges?
Okay. And yeah, so I'm recalling this work that we've been doing with CEW, and perhaps Kanika was here last time. And this is one of the ways to, and this involving discoms, and I'm sure there was a lot of discussion around that. Involving discom is important because discoms are the last mile to the consumer. And since discoms are the last mile, there has been this concern that discoms will basically impede progress on these projects. And so if we can get the discoms involved, and there are many different ways, one way is obviously the discom becomes the provider of these solutions. The other way is the discom is enabling flow of capital by raising capital itself. In any of these cases, it will help the project get financing, because if the discom itself is raising money, perhaps you have a state level financing happening, and that helps. Or if the discom risk itself has gone down, it will become easier for these projects to raise money. But even without that, there are issues around the credit risk and the payments being delayed from the actual off-takers, which is the SMEs, which needs to be addressed.
Great. Good. Then maybe Girish, and we've seen a number of new. So this RESCO model really requires new types of players to come in. So in the U.S., we saw some big names both come and go in using the RESCO model. Probably SunEdison being the most famous of those, but there still continues to be a number of increasingly large companies. Europe has got the same. So what have we observed so far in terms of who's stepping into that space as a RESCO? Who are the RESCOs in India, and are these entirely small companies? Have any big companies taken up that challenge? What are you seeing?
Yeah, we're seeing everything. And I just want to make sure that everybody is on board with the RESCO model. Perhaps I went through it quickly, but the idea is that we are not trying to raise capital directly as a consumer. What we want to do is we want to sign basically an agreement, like the agreement we have with the DISCOM. We want to have an agreement with a third party who would provide us electricity from solar, and we pay them. And this third party is what we call the RESCO. Is not only bringing in technical expertise, but it's also bringing in financing in many cases. Now, going to Charlie's question, what we are seeing is in the beginning, by the way, this space in India is very active. It's highly fragmented. Right now, what we have seen is that to a large extent, it's a buyer's market in some sense. And in the early days, we saw a lot of small companies, and we've been running this project preparation facility, so I'll talk a little bit more about that. But we are starting to see the big companies starting to come in, and big obviously means not from a Tata Adani perspective, but big companies from the perspective of the large independent power producers in India who have been installing utility scale power projects like Renew and CleanMax and Hero, etc. So that's starting to happen.
Okay, there are a couple more things here. There's a really interesting question about the role of private equity in all this, but I think let's save that until as you come on to the some of the sources of financing. There's one other question, and I'll just take this one before we move on about the question is the grid parity and RE tariffs going lower than variable makes it compelling, but the variability and so on that coal plants or some other form of backup is going to need to be there. So unless there's carbon pricing, it will be difficult for these balancing reserves to emerge. And the question is, what's the carbon pricing scenario across the world? I'll just say myself on two things there, and then Girish, interested in your thoughts as well. We have we did some work earlier this year. I will make sure that we put it into onto the learning platform, but basically we modeled out what would be not grid parity, which is where the cost of solar falls below the tariff, but something that we called firm power parity, where the pairing of the solar with on-site storage behind the meter provides a sort of a synthetic tariff that would give firm power to the facility for 365 days a year and 24/7. And obviously that's a more difficult target to achieve, because now you've got not just the capital cost of the solar, but you've got the capital cost of the battery or whatever the technology is. It's actually, very interestingly though, it's easier to achieve that in a place like India than it is in a place like the UK. And the reason is because the seasonality of solar is a lot less in India. It basically dips in the monsoon seasons, but in the UK, you obviously go through a period in the winter where you have very little production. So I'm happy to we'll share that paper with people, and that's one way to think about this challenge is what's the form of backup that firms the power, whether that's an on-grid, that's coming from coal or coming from natural gas, or whether it's a behind-the-meter energy storage solution. And so we'll share that with you, and hopefully that's useful in thinking about the long-term economics of this. And then on carbon pricing, Girish, maybe you want to handle that. There's certainly, we can also put into the learning platform. There's an annual report by the World Bank that's very good, that always surveys where carbon pricing is heading. But Girish, maybe talk about your experience with how carbon pricing could evolve in India and how that could be beneficial to the sector.
Okay. Yeah. And just to add to a little bit to what Charlie just said about integration issues and system costs. And I think the way to think about that is what is the cost at the system level, not at a particular plant level. And electricity systems are pretty robust. They can absorb renewables up to 20% by generation fairly easily. When you start going beyond 20% by generation, then it's starting to become an issue. And obviously there are going to be issues locally. And India and any of the NDCs does not go beyond 25%. So even though I expect that balancing and flexibility needs are going to grow, but we are still at a fairly low percentage of renewables in India in any of the NDCs. Second thing about carbon pricing, I mean, India does have a carbon price. We do have a carbon price that no one else has, which is a tax on coal itself. It's not high enough, and I'm not sure if there ever be a carbon dioxide price in India. But if we have a coal price, it is likely or possible that we also have a CO2 price. But that has proven anywhere in the world to be a very, very complex process, leading to supporting renewables in many different ways. I also wanted to take a crack on, and in interest of answering the questions that have been raised on private equity, and I can take a question, detailed questions later. But what we are seeing is that as we work on increasing availability of debt to the sector, we are starting to see availability of equity becoming an issue because only the large guys are able to raise equity or private equity. The smaller guys are not able to raise private equities, and I can take it offline as well. There are ways we are looking at to raise equity for a lot of these small guys. But perhaps, Charlie, we move forward.
Sorry, I had to unmute. Yes, great. Let's keep going on.
All right. Okay. So now I'm going to move to a second section, which is a bit long, and I will also try to watch for time. So I may end up skipping a few slides, but the idea is that I want to talk about two of the initiatives I've been involved in. And I think these initiatives are useful because they give you a concrete example of what is happening in terms of catalyzing finance into India. The first initiative is called, and basically these two initiatives, they came out of US-India bilateral talks in 2016, and there has been a lot of momentum behind these. The first facility, which is called the US-India Clean Energy Finance Facility, or US-ICEF, is already operational since early 2017, and it's a project preparation facility. I'm going to talk about that a little bit more. And the second facility is a what you call a US-India Catalytic Solar Finance Program, which is for creating public money funded risk mitigating instruments, for example, for the credit issue that I just talked about, but many others. And that has been worked on in the last year or two, and we are hoping to see something coming out of this soon. Now, each of these facilities was supposed to be tens of millions of dollars. US-ICEF was supposed to be a $20 million facility, and US-ICSF, which is the second one, it was supposed to be a $40 million facility. And the focus of both of these were on distributed solar. So now let's just get into describing each one of them to get you a sense of what issues these are solving. I've already talked about some of the barriers and how they're solving them, because that's where we start getting into implementation. We start kind of moving capital. So starting with the US-ICEF, which is US-India Clean Energy Finance Initiative, it started in second quarter of 2017, and the idea or the objectives are to help prepare high quality investment grade project proposals. And it may not mean much, but I'm going to get into the details of what it really means. But essentially the idea is that it is a facility to support investors, to expedite the technical, financial, legal, and regulatory processes that they need to go through to approve loans. And it's primarily for providing debt. And the target segments include primarily distributed renewables, rooftop, ground-mounted solar, off-grid solar, and as well as financial intermediaries. And this is key. What we have realized is that just funding companies directly is not going to scale. So we need to finance intermediaries, non-banking financial companies that will enable more higher flow of capital. So what is the issue that this is trying to solve? Because it's still perhaps not clear what project preparation means. And so we take a step backwards, and what we are thinking about is that there is a company that has done a proof of concept. The company is trying to scale, and company, I mean Eresco. And this is a key distinction, because we are trying to focus a lot more on the Eresco model now, or the OPEX model. And the company is trying to scale and is looking for debt. Because it's a new sector, because the company is small, it's unable to raise debt. And even if development financial institutions come into the picture, development financial institutions like OPIC or even IREDA come into the picture, and they want to lend, these banks have very strict lending practices, which are common to any bank. They want to make sure that the technical assessment of the resource is done properly, the market assessment has been done properly, legal stuff has been done properly. And so a lot of these things need to be done, and this is collectively called project preparation. And the whole idea is that this facility, which has been set up, will provide grants to small scale developers or sectors where this money needs to flow, provide this help to get much needed debt to move. Going down, and if you're interested, this is the process of this facility. The project developer, starting from the left, the project developer can go to the website usicef.org. It can apply for a grant. It provides an application. Then what happens is that CPI, which is the project manager, evaluates the proposal. So essentially CPI or the USICEF team is basically front end for banks. They're evaluating proposals for loans. They're evaluating whether a company is is ready for getting more debt. What are the gaps that the companies may need to fulfill before it can be eligible for debt from development financial institutions like OPIC. Once the gaps are identified, and once it's been identified that the company can actually go through the process, the CPI's team basically works with a set of empaneled service providers to perform these services, these gaps that have been identified, and then prepares what is called a detailed project report that is then taken to banks. And so this has been going on for a while. As I said, it's been a year and a half. And at the bottom, we have listed multiple partners. This program has been funded by multiple foundations. It's MNRE, which is the ministry in India, is involved. IREDA is the implementer of the facility. And then we have a lot of lending partners, starting from OPIC, but now IREDA is a partner, Tata Cleantech Capital is a partner, even SBI, which is running the credit line from World Bank, is a partner. So people are seeing the value of this project preparation facility quite a bit. What the facility has done so far is essentially 3 rounds of grants have been approved. About 25 companies have been selected, and to kind of again revisit Charlie's question, most of these companies are smaller companies because we are trying to be additional to the market and not kill the market or not do what the market would do anyways. We have provided about 2.3 million in grant funding, and we expect, and some of the impact numbers are here, but the idea is that if all of these projects go through, we should get about $120 million of debt financing to these companies, which is leverage, which is used a lot in climate finance. Leverage means what is $1 of public money getting in private spending, and here it's $1 of public money gets about 60. So leverage is around 60. Now,
Girish,
yes.
just before you move on here, could you maybe because one of the things that we've addressed a couple times is about some of the regional differences and why some states are progressing. It's very interesting. You have in this map here, you have certain states, I assume the ones shaded in orange, in which projects have happened, and then a number of states in which haven't. Can you talk us through just a little bit about why that's occurring and what that's being driven by?
Yeah, we haven't gone that much into why we are getting projects from these states, but if you look at these states, many of these states, and so by the way, these include rooftop solar as well as off-grid. So if you look at Rajasthan, you look at Madhya Pradesh, you look at Maharashtra, then there on the top left, and then bottom right you see Andhra Pradesh and Telangana. It's all related to policies, the tariffs and the policies. Maharashtra, for example, tariffs are pretty high. Rajasthan, because it's good solar. Madhya Pradesh has amazing policies, amazing procurement. Telangana and Andhra Pradesh are also pretty active. So that explains that. And then you see UP, and the UP, the main thing in UP is the mini grid policy. And if you guys are aware of this, UP is the first state to come out with the mini grid policy that gives comfort to mini grid developers. So there are different reasons.
Great, thanks. So maybe we just do a minute, 2 or more, and then we open up for some more questions. Does that sound?
Yeah. Actually, I am watching time. So we are at total 45 minutes. How much more time do I have, Charlie, overall?
We go with the whole thing. We need to be done in an hour, so we've got about 15 minutes left.
15 minutes, okay. Yeah. So what I'll do is I will actually not cover the last section, which was the detailed deep dive into one of the solutions, because we'll keep it high level. So perhaps we just take questions now for 5 minutes on this project preparation, because I mean, I'm not sure, I haven't actually gone through the breakup of the stakeholders, but love to kind of get a sense of how things are going for people in the class, and whether they see any kind of use for a facility like USISF.
Yeah, great. So there's a couple of participants that work for IEX, and they've put an interesting question there that's quite dense. So maybe I invite them to unmute their mic and maybe ask that question directly.
Could I also see the question? Where is it?
In the group chat, you'll be able to see it. So let's see if the gentleman from IEX, maybe they can, I don't know if you just need to unmute your mic. So on the far left corner, there'll be the mute. It'll be by default, it'll be muted, and you just need to press it to unmute.
Okay. I get the question. So I think what it's referring to is that the renewables are procured outside the market. and market means because IEX is a market, so what can be done to procure renewables in the market itself? I think that's a good question. One of the issues is that renewables are capital intensive, and to trade renewables in a market which is basically based on recovery of marginal cost, it kind of looks anomalous. But what we are starting to see in many situations, because if renewables are procured outside the market, then renewables are not getting market signals for example, or even some of the fossil plants are not getting market signals to back down when system is not balanced, and that puts a lot of pressure on the system. And so what's starting to happen is that despite the fact that renewables might have contracts outside the market, they're forced to participate in what we call the dispatch decision. And that's starting to happen in many of the states in the US. And I think that is something that needs to be considered for market dispatch rules everywhere in the world, so that renewables are part of the dispatch. And the moment they're part of the dispatch, it will start addressing, and it will start giving the right signals for flexibility as well. So this is definitely a very, very relevant question, and I think there is work being done, and that needs to be done in India as well.
Good. Girish, could you walk us through, I know we don't want to get into too much of the detail, but definitely, the discussions you and I have had around the credit enhancement and credit guarantee, both the stuff that's been done within the context of the US-India bilateral, but kind of more broadly, the mechanisms actually by which credit gets improved, and there's a bit of moral hazard there, obviously, and that somebody's then, if market-based credit is poor, and then an intervention is made to enhance it. Of course, there's that doesn't come entirely without some risk to the participants who are providing that credit enhancement, and ultimately some distortion into the market. So maybe you could there was an element of the presentation we were going to talk about that, so maybe it'd be interesting just to explore that a little bit, because I thought that's a really kind of a key piece of the puzzle.
Yeah. So what I will do is, we can put these slides up for people to see. What I'm showing right now is a very broad overview of a lot of these barriers, and these are the barriers we are trying to address through the Catalytic Solar Finance Program. So you can see that it's very comprehensive. The slide itself might take the next 15 minutes. I'm going to skip over that, and then the next slide. Let me go to the next slide. It talks about development of some of the solutions. What I'm getting a sense from Charlie is that perhaps it's more useful to stay focused and talk about this one specific intervention. So the idea is that what I already kind of brought up, and what I brought up is that we have the RESCO model. Just to remind people, we have the RESCO model. In the RESCO model, for the RESCO model to scale, we need access to finance to small and medium enterprises. And the real issue, as I mentioned, was when these projects go to bankers, even to any of the credit lines that are available from multilaterals, the issue of credit, either low credit or non-availability of credit, becomes an issue. Now, it's very hard to do something about non-availability of credit, but lower credit could be addressed in many different ways. Now, that is one issue. The other issue is many times these SMEs have cash flow variability issues. In short term, their cash flow is not that stable, so they might end up delaying payments. So the idea is that you're not only dealing with credit risk, which is that an off-taker or the eventual buyer will default in payment, but also that they might delay. And the idea is that you want to have a facility that and what happens is that if off-taker is delaying a payment to the RESCO developer, or if the off-taker completely defaults, because in the project, all the revenues are coming from the off-taker paying for the power. The developer, if the developer has taken a loan from the bank to finance the project, is no longer able to pay the loan back. So this is the risk that the lenders or the banks want comfort against. So in very quickly, I've talked about two issues. One is what we call payment delay, which has to do with cash flow variability or the liquidity issues that the small and medium enterprises face. And the second is the issue of credit risk. And so this facility that was created, we call it a credit guarantee mechanism. It is a mix of two facilities. The first facility is called, it's a first loss facility, or it's called the Loan Risk Reserve Pool, LRRP, which in the diagram on the right. And the idea is that it covers for delayed payments up to 6 months. And banks like this because they don't want to get into the issue of non-performing assets if there's just a delay. On the other hand, if the delay goes beyond this limit, then there has to be a default, and the loan has to be declared a non-performing assets, and then we have a second pool of money, which resembles a classic partial credit guarantee, which is covering for approximately 50% of the loan. One other thing I wanted to say here before I go into the process, that you can design this facility using techniques in credit risk analysis. It's typically, you're looking at probability of default, you're looking at exposures to default, you're looking at loss given default, and you can figure out the sizing of the facility. But the key thing here was, again, the leverage number. For $1 of public capital, you're able to leverage about $10 of private capital. So this facility is being discussed right now. It's been approved at the highest level, and now it has to be operationalized. Coming back to Charlie's question, and I think that question is important before I get into how this facility is going to work. There is always an issue if there is a third-party facility that is providing any kind of guarantee to the sector, and the user of the facility might game the system, right? So there are different things that are built in. One is the partial credit guarantee is only for 50%. So lenders should not be taking excessive risk. Lenders' skin is in the game. There is also a charge for the facility. So the facility manager, which is likely to be a public sector company like Arvida, will manage this fund, and they will charge the lenders to use this facility, and the lenders will eventually charge the developers. So at the end of the day, the charge or the cost of this facility, some of that will filter down, and again, there's skin in the game. So these are ways to deal with this issue of moral hazard. But I just want to, Charlie, I don't know if I have time to go through the process. I am happy to take questions now, or just go through this last slide.
I would say there's been questions on, there's questions on the chat, but I think that why don't you go ahead and let's see if anybody else puts in, but let's crack on. I don't see anything that isn't being addressed within the chat. So let's go on. Yeah, and this is pretty much the last slide. I just wanted to give you a sense of the practical nature of this thing. The idea is that there will be some public money put aside. We were initially thinking about $20 million. So the idea is that will enable about $200 million of lending. There will be a trust that will hold the facility. The trust will hold the money for both the pools. It will appoint a facility manager. And then the facility manager will manage the facility. It will provide that as a service to lenders who feel uncomfortable lending to certain projects, and the facility, as I mentioned, will receive fees for providing this support.
And the role of the facility manager is to also monitor and verify the claims that have been filed. And the lenders can avail of this facility, and then finally there's a loan beneficiary who eventually gets a loan because the facility is there. I've also shown some of the calculations on the right hand side, but the idea basically is that given a particular amount of public capital, if it's 10 million, I can facilitate about 100 million of private sector capital. If I have more money, I can do more. But there has been an ask for this from all over, including from the existing credit lines. So that's been great, and hopefully this will get implemented soon. Where I will end is that, despite the fact that we have talked about one solution in risk mitigation, there are a lot of different issues that we've been looking at, and there are a lot of different solutions that have been floating around, and we've been involved in a lot of them. But it's been an exciting journey, and I think a lot of this needs to be done before the capital or the potential for financing this sector can be attained. So I'll stop there. I think we have pretty much reached at the end of my time, but happy to take questions. And Charlie, I don't know how many questions you want to facilitate, but I'm happy to stay on for a little bit.
Yes, well, we'll try to get everybody back away because just because we know they got, it's the middle of the day in India and things going on. Shubha, do you want to just any issues there? You've been kind of active in the chat. Maybe we'll leave the last kind of word with you, or some of the issues that have been coming up. Maybe you could just summarize those.
Hi, Girish sir. Hello.
Yes, hello. We can hear you.
Yeah, hi, Girish sir. This is Otto from Skill Council for Green Jobs. I would just like to ask you that you have given a brief about the international programs funded by international agencies and all in different states of the countries, which are majorly like Rajasthan, Odisha, MP and all. But can you tell something about the programs which are also done by different international agencies across the country?
Programs by different agencies across the country.
Yeah, just a brief about different programs going on in DRE and rooftop solar.
Yeah, I mean, so I'm more familiar with financing, but I think there are multiple programs. A lot of work has been happening on DISCOM reforms. A lot of work is happening on, and there are a lot of public money that's going into what you call the DISCOM reforms, the power sector reforms. I'm also aware that a lot of money is going into the off-grid sector. Many of the public sector agencies are looking at, for example, Rockefeller Foundation had a smart power program that was focused primarily on mini grids. I have also seen USAID and DFID going into different states and working with state level agencies. But I think what's interesting that's starting to happen is that a lot of these public sector agencies have realized that most of the work needs to happen at the state level. So a lot of work has started to happen at the state level as opposed to the central level.
Good. We're just at the end of the time here, Girish. So we're probably going to we need to let people go and get on with their day. A lot of the value here is obviously the discussion that happens in the session, but also, there's a project that increasingly we're going to be asking the cohorts to turn their attention to, which is designing a procurement policy or a strategy for an example, corporate in India. And a lot of what you shared with us today gives us a lot more resolution around how that procurement plan could incorporate on-site solar and how that and how that could be supported through various mechanisms. One of which is finding a developer who can provide us with an OpEx solution, and that becomes a more tangible possibility when these kinds of support mechanisms are available to them. So It's really been good to get into that detail. Really appreciate, again, you spending the time to do that. And I'll just say to the participants on, really, as we kind of move towards the end now of the course, we end with sort of what is the prepared content, but really we will be working harder now in order to get you all engaging with each other, particularly within the learning stream that you've been assigned to, so that we begin to get some action around how do you take what we've been talking about and turn that into something real, and something real in that case is a set of decisions that a company would take, or you imagine yourselves taking, in order to incorporate all this and say, what is the kind of procurement policy that I'd want to put in place over the next 10 years, and that would be value enhancing for my company based upon what the options that are on the table. So Girish, thanks again for giving us insight into this area. You're happy for us to share these slides. We'll put those into a PDF and put them on the platform, so that any of the things that people want to come back and look at. And wish everyone a really good day, and we'll look forward to speaking with you again next week.
Thank you.
Bye-bye.
Thank you. Thank you.
Okay, thank you as well. Safe trip home, Shubha.
I'll see you back. Thanks, everyone.
Bye-bye.